Nearly 20% of office spaces are currently empty across the United States. This is higher than the vacancy rate during the 2008 global financial crisis, and it's worse in places like San Francisco and downtown Los Angeles, where more than a quarter of offices are empty. Rising interest rates, falling prices, and the trend of hybrid working in the wake of the pandemic reduced demand for office space, straining the commercial property market, and these troubles have only gotten worse as the recent bank failures raised fears about other regional banks that account for the bulk of commercial real estate loans running into trouble. Economic concerns and the regional banking crisis have led US banks to tighten their lending standards for all categories of commercial real estate loans, according to the latest Senior Loan Officer survey published by the Federal Reserve. A majority of US banks said they tightened credit standards for loans secured by non-residential properties in the first quarter, while none said that they eased standards. Some lenders are even requiring personal guarantees from property owners in which borrowers pledge their personal assets to secure a mortgage. The extent to which these more restrictive lending practices prevent existing borrowers from refinancing commercial real estate loans still remains to be seen. If companies continue to give up their leases, and if demand for office space remains as slow as it has been, office landlords will struggle to collect enough rent to keep up with mortgage payments to pay off commercial loans. A lot of these loans are coming due in the next year, and many building owners need to refinance their debts at a time when low occupancy has eroded building values, interest rates have gone up, and banks have become significantly more reluctant to lend. This is not just an issue in the United States. While workers in Europe and the UK have been quicker to return to the office than in the US, vacant office space in the UK is still at its highest level in 9 years. The amount of empty office space having climbed steadily since the start of the pandemic in March 2020. Swedish office landlord Castellum had to issue additional shares and has divested some of its properties to reduce its loan-to-value ratio from 44% to 38%. SBB, one of Sweden's biggest landlords, abandoned an equity capital raise, cancelled its dividend, and is now selling off assets to reduce its loan-to-value ratio from 47%. German residential landlords are expected to make their own cash calls in the near future. Earlier this month in the UK, St James's Place Property Fund sold 141 Wardour Street, an ageing Art Deco block in London Soho, for £39 million, which is 30% below what they paid to buy the property back in 2018. British Land, one of the UK's largest landlords, announced on Wednesday that property values had fallen 12.3% in the first quarter of 2023. Valuations for offices and factories have fallen almost as much over the last year as the 20-month price decline that began in September 2007. So overall, things are not great for landlords. KKR is suing Twitter for unpaid rent, as Elon Musk has reportedly stopped paying office rent in California, Boston, and London since he bought Twitter last year. This is likely a negotiation tactic for lower rent, but legal experts argue that it's unlikely to work and will cost Twitter more in the long run than a good faith negotiation would. Now, while things are not going well for commercial real estate investors, increased defaults and foreclosures could cause problems for banks that make commercial real estate loans too. The majority of the $1.2 trillion in US office space debt is owed to regional banks who have been more aggressive in this style of lending than large, too-big-to-fail banks have been due to the lower regulation that they have faced since the credit crunch. If office landlords can't make their debt payments, these banks would end up owning the commercial properties and would need to sell them, which would be difficult in such an environment. The problems in commercial real estate have drawn the attention of the Federal Reserve, who published a report last week saying that they've increased monitoring of the performance of commercial real estate loans and expanded examination procedures for banks with significant commercial real estate concentration risk. When trying to understand the extent of the problem, it's becoming more and more difficult to even calculate the actual value of office buildings in the current market environment. Investors are looking at things like office badge swipes and cell phone usage in business districts to get a better understanding of how much office buildings are being used and what the demand for office space will be going forward. Academics Arun Ramani and Nicholas Bloom wrote a paper last year called The Donut Effect that used data from the US Postal Service and Zillow to understand the migration patterns and changes that have been happening in real estate markets in American cities. They found that in large US cities, real estate demand shifted from central business districts to lower density suburbs and exurbs, which gave them their paper title, The Donut Effect, which reflects the hollowing out of city centres and the growth of suburban outer rings, which appears to be happening. They found sizable donuts in large cities, smaller donuts in mid-sized cities, and no real changes in small cities on average.